Welcome everyone. Thanks, Prof. Srini, for the kind introduction. And I'm hoping there'll be some wonderful learnings. There will be some interesting and challenging questions, just the same as Prof. Srini said. Ask them when they, as I'm presenting, and when they come to your mind, so that we don't lose the chain of thought, and you can ask many more questions. We will be taking small breaks to answer them as well. So I hope everyone can see my screen now. And this is a wonderful initiative by SMU, so I would like to thank them just the same. They have been pioneers in the marketing industry and various different aspects. Valuation is a relatively new field still, and I think that's where some of the understanding of some of the gaps might be reasonably wider. But having said that, in the last 10 years, it has evolved a lot. I've been with brand finance for 10 years, and I've seen it evolve a lot. It's now become more of a tool to manage marketing ROI, the management KPIs, and the whole thing. So it's no longer just a domain of the financial experts. It's no longer just the domain of the accountant. It has now it has moved across the full spectrum of brand marketing management, just the same. So you'll see a lot of those, and if there are any questions, do feel free to ask. I'm not sure how many people know the value of some of the world's largest brands. It would be interesting to see a show of hands. How many of you actually know the value of a lot of the brands out there? If you don't, that's all right. That's what we are here for today, to learn more about them. So starting on brand and brand value, what does it all mean? How does it all stack up? What does it mean from the organizational point of view, as well as from the customer's point of view? So we are going to be looking at multiple facets of it as we move along. Here is the hard truth. More than 1/3 of marketeers or brand owners, they do not have an ROI measure for their brand and marketing initiatives. I mean, how does it to be believed? When we say marketing initiatives ROI, of course, everyone does research at some stage. Everyone does look at their internal data, sales information, etc., and they would probably call them some very effective ROIs. And we'll touch upon those later, how some of these are either too internal, too inward looking, or they're not as effective as, you know, having some more robust ROI, which are more externally facing, or which have more alignment to the values or a dollar value, etc. But yeah, the bottom line is majority of the marketeers do not have a robust ROI for their marketing initiatives. What do we mean by ROI? It's basically gain from investment. When you take out the cost of investment and divide that by the cost of investment, what you get is a number. It's an ROI, and it's the number that you're looking for. So when the CFO has $100 to spend on a particular initiative, they're basically toying in their mind, who should I give it to? Should I give it to the manufacturing guy? Should I give it to the marketing guy? Should I give it to set up a new business? Should I give it to a new geography? Where should I be investing this $100 to get the largest ROI? And that's where most of the time the brand and the marketing teams tend to lose out on that $100, because they cannot convert their efforts and initiatives into a dollar outcome. And we'll talk about that, how that can be done going forward. Also, that $100 must generate $300, $400, $500 in return in some way or the other, and not necessarily a 5% increase of awareness or 3% increase of loyalty or 2% increase of consideration, because that is very hard for the CFO to then use as a benchmark and compare on a likes for like basis. So ROI is the benefit that they're all looking for, the investors, the boards, and everyone in money. And that's one of the reasons also that we have seen why the marketing dollars are always under the axe come some crisis, or come the third quarter, the fourth quarter, when the company is looking at increasing the profit for the shareholders. Where do I cut costs? Let's cut the marketing budgets, because they do not see the ROI the way they see in some of the other areas. ROI from brand efforts, of course, you have advertising, you have sponsorship, you have other areas in terms of CSI, etc. And different people call it different things. But the bottom line is those are all your activities and initiatives. And there are tangible ROIs that the company has in terms of sales and profits. And that's what they're sort of tracking internally because they're tangible and they see where they stand. The intangible ROI is really about the identity and the imagery and the perception, the reputation. And that's what the companies are tracking or the marketeers are tracking. But as I've said here, those are intangible ROIs. And it's very hard for the management to see through how should I compare them with the sales and profit numbers, for example, or what the contribution is. There is another one there, which is the value of the brand. And I think that's something that most of the marketeers do not have a good sense of. For no fault of theirs. It's been an accounting domain historically. And perhaps people like us are also to increase our part in taking it to the marketeers. But value is an intangible ROI. And while you're measuring all the other intangibles, and they are all intangibles nonetheless, then why not start to look at something that's more directly relatable to the board, to the management, to the CFO, and you can compare them against the dollar investment that you're actually seeking them to give to you. Here's the world that we are operating in today, and that's been like for the last almost 20 years, if I can say so. We are in the ideas economy, and that is the economy of intangibles. It's all about ideas. 10 years, 15 years ago, we would not have imagined to have a company that will provide accommodation without owning a single hotel room, for example, and there is Airbnb today. We would not have imagined a company that will provide transportation without owning much of the fleet that is there. And we have Grabs and the Olas and the Ubers of the world all around the world now. So the intangible is what's driving. There is a reason why most of the organizations today have multi-billion-dollar valuations when there is very little tangible assets that they own on the balance sheet. Most of the startups, if you say, why are they so extensively valued and why are the investors pouring so much of money in it? It's because of the intangible value and the benefit that they see coming their way in the future, and that's the reason. So for a startup, usually the tangible assets might be very, very little, but it's really the intangibles that people are investing in. That's really where the shareholder returns come from. That's where the shareholders get their returns. That's where the investors get their returns. That has to be a focus of the management at all times. It is the most powerful intangible for creating shareholder value. Just to give you a small illustration, brand ROI, it definitely simply means price premium. If a brand does not command a price premium, there is something seriously wrong with the brand. And one could argue, but what about all these other brands that generate lots and lots of volumes? Well, they are more on the commoditized side rather than the premium brand side. A premium brand or a brand must generate, if you're not earning $10 more than something that's not branded, then there is no role that the brand is able to play. Take this cap, for example. Not sure how many of you would want to buy it. Well, it's an interesting looking red cap to begin with. And well, let's just say you would pay $10 for it. Now, here's the power of the brand. The minute I put a Ferrari logo on the same cab, made from the same material, made in the same factory, everything is the same. Certainly, you would want to pay $30 for it. Where does the $20 suddenly come from? That's the value that people are willing to pay for a brand. I mean, take your iPhone, for example. If I hide the logo or just remove the logo from the back of the iPhone, nobody would pay $1,500 for it. You would probably pay $300, $400 for it. So the purpose of the brand is to drive premium. And if you're not doing that, if you're forever forced to discount, and that's the only way you can sell, then there is something that's not working with the brand and need to start to look back and see what is that's something that's not working and how should I fix that. Another example, Kindle, $180, iPad, hugely popular, much more expensive, more expensive, and many times more volume generation. So again, if you say, I'm going to discount it and I'm going to be able to sell it in numbers, that's not always going to be the truth. he says it better than anyone else. I can make a whole lot more money skillfully managing the intangibles rather than tangibles. I think the key words there are skillfully managing. And that's where we've always historically or otherwise seen the gap in the marketing world, where the skillful management part is missing. They're just, most of the time, intangibles are just left entirely on their own. They're being managed somehow, somewhere by somebody, but there's no real effort or measurement of how is it being managed, who's managing it. So long as the brand value is increasing, nobody really bothers about it. When it drops, people say, all right, probably the people who are measuring that may not have done a good job, or things that I don't understand. But in an overall scheme of things, it's never really an agenda for the board or the management. In majority of the organizations, there are organizations that take it very seriously, the intangible value, but majority of them don't. Another big myth or misconception, again, with the companies and the boards and the management, is if they see the share prices increasing, if they see the value of the business is increasing, the enterprise value is increasing, it's assumed that the brand value is also increasing. That's not true at all. The two have very little or no coordination or nothing to do with each other. One can go up, the other can go down. Enterprise value can constantly go down, and the brand value may still remain stable or may go up, actually. So it's a myth that if one is moving up, the other is automatically moving up, which again makes people believe that everything is all right on the brand side. Not always the case. Intellectual property is a very, very important tool, and it basically is a win-win situation. When you don't exploit your brand, when you don't exploit your IP, and again, when I say exploit, I mean there are many other ways to exploit it rather than just use it for your own business purpose. You just leave money on the table, and you don't take advantage of the brand that you have. I'll give you a small example. There are companies that actually only own the brand and do not own any intangible assets, tangible assets. They're extremely, extremely valuable around the world. I'm sure all of you have heard of Four Seasons hotels. They're actually the top 5 most valuable hotel brands in the world. And guess what? They don't own any of their own hotels. All they own is the brand, and they license it to everyone. And that brand then makes money for them. And they're the 5th top 5 most valuable hotel brands in the world. So you don't necessarily always have to have an asset, which is a tangible asset in hand. You can just have a brand, and that can actually win lots and lots of money for you in the long term. We've seen tangible assets delivering significantly higher proportions of return versus the tangible assets. Now, why do companies value brand? Or there are many reasons and ways to do it, but let's just first look at what is this whole universe of brands that we call brand. It's actually not just one thing. It's a group of things. It could be trade names, trademark, service marks. You may call them different names, but they all fall under the purview of brand. And when we're actually doing the putting a dollar value to them, we are actually looking at all of these. Product design, packaging design. So for example, the Coke bottle is a very important part of their brand, and the color of the bottle is a very important part of the brand. And sometimes the caps, the way they put it, is a very important part of the brand, and those actually add a lot of value to the brand. If you're a British brand or brands from the Royalty Association, you have coat of arms, you have certification marks, ISO certification, for example, and all those, basically all the accreditation there, all these things add a lot to the brand. Take colors, for example. Not sure how many of you know, but Tiffany, actually the Pantone color is so important. The Pantone actually prints the paper for Tiffany, and nowhere else is it printed. And the code for the Tiffany color is actually the year when Tiffany was formed. So there's a very special color. So sometimes the colors are extremely important to people. Packaging is extremely important to people. I'll again use the Tiffany example. One of the most valuable assets that Tiffany has is that little box that the products come in. In fact, the box is kept in safe just the same, because you can never buy an empty Tiffany box. So the packaging gets extremely important. Smell, sound, slogans, those are all intangible assets that are extremely valuable. Harley Davidson has the sound patented for the bike, and nobody in the world can actually copy it. So there are a lot of different things that fall under this, and you must understand in your line of work what are these intangibles that are actually driving the value of the business, or that are contributing to the success of your growth and customer preferences. And that's how it would all come about. And that's why you'll see some of the multinationals are so particular about their colors, so particular about how the logos appear, and so particular about a lot of things, because any changes that you may make casually otherwise can actually a lot of times destroy the value of the brand and not necessarily contribute to it. What are the benefits? Well, there are two ways to look at this. There's a financial side and there's a management side. Financial side is more external, which you can use it for a financial tool during the lot of other things. I'm going to first share the management side. It's a way to get the insights into the brand, what's working, what's not working. It's a way to drive your strategy. You can benchmark yourself against all the competitors and how they're performing. You can drive some of the education within the organization about the brand value, about the intangible value, and I'll come later about how important it should be to the management and how do you sort of put that in front of the management, which will then really make them sit up and take notice of it. Communication and understanding. So there are a lot of different benefits of brand valuation that will actually can be realized once it's used in a more structured, in a more organized manner within the organization. The financial side is investor relations. I mean, when we publish the brand values, and a lot of companies actually use that in the PR, they go and release a press release. Suddenly their share price goes up by 1% or 0.5% or 2% or more at times. So it's a good investor relation tool just the same. It is used extensively in M&As to get the right price even before somebody comes on the door. You should have a price in mind so that you know whether the offer that you're getting is right or wrong. JVs, licensing, litigation is again very interesting area where valuation does become very important. Time provided, I'll probably share a very interesting example later about the litigation side. Businesses recognize the brand, the value that the brands create, and a lot of them actually write it in the balance sheet. They actually mention it if you read their annual reports. There is always this question about should we or should we not write in the balance sheet? Can it be put in the balance sheet? The answer to that is a technical one. We'll come to that later, but lots of different brands actually mention the brand value so that the investors are aware, so that the stakeholders are aware. Public companies, so we've done this little survey just to understand how important this space should be, and we looked at the public company disclosure and the analyst view in terms of what do you think should be done, or you think there is enough being done in this space. And 50% of the analysts believe that they're not getting enough information about the value of the brand, or the intangible assets of the companies, because whenever you look at the annual reports or the balance sheets, etc., there's a lot of undisclosed value that is there. And when I show you some of the gift analysis later, you'll see what I mean. There's a lot of undisclosed intangible. Basically, nobody knows what they are. It's just amount that's sort of left. So when you're calculating the value of the business and you start allocating it across different heads, then whatever is left historically used to be called goodwill. But over the period of times and as the valuation has become more mainstream, people do tend to put that goodwill, split that into some other intangibles, but majority of them remain undisclosed intangibles. So that's what the analysts are saying we want to know more about them. We want to know what value is to the intangible assets, and what is the value of the brands, just the same, and very little is being actually shared in that space. We're also talking about acquired intangible assets. So when you buy a company, you actually, as per IFRS guidelines, the financial regulatory guidelines, you're supposed to disclose the different values of the different intangibles that you acquired. And analysts are saying, look, yes, I would want to know those also in a more transparent manner. Even internally generated brands should ideally be mentioned, or companies should make an effort to put these out in their annual reports. They can't add them to the balance sheet, but you should be disclosing these in the annual reports in the disclosure sections. Should they be valued each year is the next question that comes to your mind. Absolutely yes. So people are saying, the analysts there are saying, yes, they should be valued each year so that we have a better sense of where this company is headed. So it is becoming more mainstream as a measure of companies' success going forward. And the analysts are trying to look at more and more into this space. And the companies that are more actively sharing this information and data are actually benefiting a lot more from the investor's point of view and from how they write positively about those organizations and companies than those who don't share anything with them. So that's just an overall overview of valuation. Do strong companies perform better? Of course, this is just when the companies are strong, when their value is higher, the brands are stronger, they significantly perform better. So we did some analysis from historically from 2008, where the S&P 500 and companies, these are the brand finance most valuable brands. You can see the gap that has sort of been maintained over a period of time, and how much better performing these companies are financially. So the stronger the brand, the more valuable the brand, the better performing brand, and the better returns to the business there will be. Valuing the brands would largely fall into three categories. Largely, there are technical reasons. So we talked about the brand value as a management tool, as a financial tool, but there are largely three broad areas why the brand should be valued. There are technical reasons, and again, those are mostly for the balance sheet purpose, or tax, or litigation, or JVs, etc. Always led by more the financial side, or the corporate advisory teams are leading that, or sometimes the regulators are leading that just the same. We work with tax authorities around the world, actually, and the tax authorities come to us to do the valuation for companies who are seen to be tax evading entities by way of floating separate IP cos. And so that's again for litigation purpose. And then they go and knock on the door and saying, hey, you've created an IP co and we don't think you're doing it correctly, and therefore here's the penalty that we are imposing on you. So technical reasons, there are commercial reasons, internal, external licensing, I talked about that, IP co and transfer pricing, divestment of assets. So there are commercial reasons of doing it sometimes. So when we are actually working with companies like the Unilevers and P&Gs of the world, we're looking at the portfolio rationalization, and that's a commercial reasons to say, get rid of these 30 brands or get rid of these 30 products, because they're actually doing nothing for your business. They're not helping you grow. Then they're actually posing to be a bigger barrier for your growth and for your competitiveness. So then you need to divest. So things can be for commercial and strategic reason is where the whole marketing world can get involved in portfolio management. I just talked about that as well. Brand architecture. When you have multiple brands in the portfolio, which ones to keep, which ones should you get rid of, or which ones are actually helping contribute to the value of the overall organization and the intangible value, and which ones are actually destroying. And I'm not using the word destroying as casually. There are a lot of brands which actually destroy the value of the organization because they're forever unsuccessfully taking away the profits, or forever unsuccessfully doing a negative contribution to the overall enterprise value. Brand strategy. Again, if you have marketing campaigns, you have multiple marketing campaigns, which one should you run, which one should you not run? The answer can be as simply given by saying, you put $100 on campaign A, you'll get return of 3 million. You put $100 on campaign B, you'll get return of 2 million. You put $100 on campaign C, you get return of 5 million. Now that's a very easy answer, rather than looking at the reams and reams of qualitative research analysis, or waiting for the loudest voice in the room, or someone coming and telling you, the CEO sometimes saying, hey, my cat put the paw on that one, so that's the one I'm going to go ahead with. So brand strategy, you want to sponsor something, you can analyze what returns is going to be contributed to the brand value, what returns are going to be contributed to the bottom line, and so on. Budget setting, again, when the CFO actually comes with the axe to cut down the budgets, you can actually tell the CFO, look, if you cut my $1 million, you're going to lose 100 million on the brand value, and the investors are not going to take that very kindly. So think about it. And most of the times, when those kind of logical, robust arguments are put forward with a very large value at stake, they do tend to back off, and you can actually protect your budget. At the same time, you can use it as a tool to decide how much money you should be spending as well. So those are various strategic reasons that the marketing fields could be or should be using. Still a slow burn there, people because are not necessarily aware of it, and hopefully after this session, more of you will be aware of it. I'm just going to run through 2 more slides, and then we'll probably take a quick pause for any questions. So any of you who have any burning question in your mind, now would be a good time to start posting them. Now, what do we mean by brand, and what is being valued and what is not being valued? And there's always this challenge about a lot of different terms that sort of come across. Enterprise value, branded business, brand value. I'll just put some clarity around that. The enterprise value is basically the total value of an organization, a corporate entity. So take Virgin as a group, Virgin Group as an example. That's where the Virgin Group is the branded organization, and that's where the enterprise value of the entire group is going to be usually calculated. Any of you who have probably more financial acumen and are wondering what does it mean between the enterprise value and market cap? Enterprise value is basically your market cap plus debt less cash, and that's how you get the enterprise value for the business. Coming to the branded businesses, and there may be a lot of different businesses under an enterprise, and those businesses by individually would be called the branded businesses. Virgin Atlantic, Virgin Galactica, Virgin Cola, Mobile, and so on. And Virgin, the brand is the brand Virgin by itself. So when we talk about the brand value, we're talking about the Virgin, the brand. When you talk about the value of the branded businesses, we're talking about the businesses that are actually using the brand. And then the enterprise value is the sum of all those branded businesses that gives you the enterprise value. So in case there are internal questions in terms of what are we valuing, that's what we're valuing. We're valuing the brand Virgin no matter how and where it is used. Just another example in case of Unilever, and so right here, the bottom is the brand value for Persil, for example. And the branded business value would also be for the Persil across all its different product lines. And then when you look at the enterprise value, that's where the Unilever as a conglomerate would come in, and all the multiple brands like Persil and others would then add up to form the value for Unilever as an enterprise value. So there are a lot of branded businesses and the different brands operating. There's one thing here in the middle that you may have noticed which is different, is the brand contribution. This basically looks at how much of an uplift is able to be provided because of using a brand. So what we do here in this case is the brand contribution is usually measured by looking at what is the price premium that the brand is bringing to the table, what is the volume increase that the brand is bringing to the table. And if this product was not branded, how much of a drop in price, how much of a drop in volume, how much of a drop in market share, etc., is going to get impacted. And that's how you calculate the contribution from the brand. With the brand and without the brand, how will this business be performing? So that's if someone is saying, tell me what is the brand contribution for this business entity, then you can do that separately. So we can take a quick short pause here and see if there are any questions that anybody would have. And if not, then we'll just move on. So over to Prof. Srini. Are there any questions?
Yeah, we have some questions, Samir. Let me actually pull them up. Yeah. Let me just quickly go through, and I'll sort of summarize them for you, for Samir to answer. Let me see, my video is off. Let me start that. So I think this is a question I think you might have already addressed, but I think the question is very specific. It says, if the company isn't that big scale or big and has only one brand, would the enterprise value be the same as the brand value for this company?
The branded business value would be the same as the enterprise value. In that case, not the brand value. So the branded business value is usually more than the brand value, because there are a lot of other forms of assets that the company has other than the brand. So when you're talking about the branded business value, you would add up all those different assets, and that's the branded business value. So those two will be the same, not the brand value.
Okay. Thank you, Samir. Yeah, so here's actually an interesting question. It says, are there any brands that have made significant breakthroughs in the recent years? I think he or she is actually trying to see, have they drastically increased their brand width? So rather than a steady one, somehow some of these brands have done a phenomenal job breaking into the top. So yeah, because you observe both globally and in the Asian markets, yeah, you have some examples that you can share, Samir.
Yeah. So yes, you will see a lot of examples later, but no prizes for guessing that the technology brands have broken the glass ceiling faster and quicker than others. In fact, if I were to just use an example or show you the brands that were the top 10 years or 15 years ago, and the brands that are top 10 now, you'll not see any of those top 10 from 15 years ago in the current top 10. So when we reach that slide, you'll see, but yes, technology brands have really spearheaded the space. There is one tiny exception there in terms of the intent from a country's point of view. And you'll see that also there are countries that are very aggressive in making brands from that country very popular. And that's a very interesting aspect. And more countries are now focusing on the brands from the country because that increases the value of the country as a brand. And they have brand programs for their own country in different ways. So I'll share that with you. But the short answer to that is there are two ways to look at this. Technology brands have really sort of skyrocketed up, leaving everyone behind. And the second is there are certain countries that have skyrocketed above the rest, and you'll see both of them.
So there is one, I think, question in two parts, but I'm just going to break it down. First question, I think, is a straightforward one. It says, when in the startup company's life cycle is a good time to engage in brand building?
Absolutely excellent question. And I was hoping somebody would ask that. You actually need to start planning it before you start the company, because that's the first thing that you actually go and register is your brand, is your trademark. So you don't have to wait till you reach a certain period, because the brand is used literally from day one. So there is no reason why it should not be planned for and should be an area of focus from day one.
Excellent. Samir, I think the same person has actually asked a question. I'm just reversing the way that it was posed. He says, how do you assess brand values and how do you maintain the consistency of story when disseminating different products? And so the person gave an example as Disney as a content creator, theme park operator, merchandiser, licensor of toys, and the real estate developer. And so what I think the questioner is asking is, if a company does so many things, how do you maintain the consistency in terms of what the brand is about?
Again, an excellent question. And I think that's where the management and the brand custodians come in. And Disney, for example, Disney, Apple, there are lots of other companies there, the banking organization, the airlines. They basically say, if this is my purpose and this is my vision and this is my strategic intent, I will stick to that as my core. And the minute you tend to move away from that core, you do tend to lose focus on your direction. And that's extremely important. Now, Disney, if they say we want to operate in this space as a company, this is what we bring to the table. Every single product that they put out there in the market must then conform to that vision and strategy, which is there for the organization. And if that's not happening, then not only will they not get any positive contribution from that particular business that's non-conforming, but they would also it will end up destroying a lot of value. So let's just say 90% of the Disney business is generating a 10% value increase, and there's 10% business that's actually generating 30% of value destruction. So you need to keep those things in mind when you look at it. And that's where some of the consistency of brand application and consistency of brand management comes in. And again, we do have a model which is more based on the brand governance, and not governance as in corporate governance, but brand governance. And that's more looking at the brand management internally. And we always tell the companies, if you have one thing to focus on the brand area, just make sure that you have proper brand governance measures internally within the organization, so that at least it's looked at in a more consistent manner and it's looked at in a more precise way internally. Because if your people don't know what all these things are, they would end up going doing all kinds of different things externally. They would all be driven by a very individual personal agenda, which is never good for the brand. It should be an organizational wide agenda. So if you don't have brand governance processes internally, now would be a good time to start thinking about them and take a very hard look at them.
Great. Thank you, Samir. So I have three questions, which I'm going to combine them, and I think very likely that you can defer the answering those questions, because I'm assuming that's what you're going to focus on. Let me actually sort of paraphrase these questions. One is in terms of what is your tool? How do you actually, what are the salient considerations or measurements that you use to essentially rank the top 10 nation brands in the world? Okay, so it's basically, I think is addressing the question on nation brands. The second is how the origin of the country, for example, where the brand originates, does it make a difference? Again, you can share that experience as you sort of go into the brands in Asia. And finally, I think what are the local Asian brands that have added the most value over the generic categories? So again, I sort of combine these three because I know that you will have those discussions, or at least in your presentation. So you can choose to answer them now, or you can actually defer it when you're actually sort of presenting the top Asian brands, Samir.
So the first and third I'll answer later. How the brands are valued and what are the key components, I'll answer later. And the Asian brands also I'll answer later. Sorry, what is the middle one again?
Which of the origin of the country, does it matter? Right? Yeah.
Yes. So the origin of the country does matter. And let me give you an example. We've done enough research when we are actually looking at the partnership associations. What is the impact of that on the brands? Now, if you're partnering with an American brand, for example, let's just say you're in Malaysia or Indonesia or Singapore, and you are taken over by an American brand, that'll have a very different impact on the overall business ability and the brand. As against if you're taken over by an African brand, for example, right, that'll have a very different impact on your ability to do business or scalability and a whole lot of other things. Or if you're taken over by a Vietnamese brand or an Indonesian brand. So the country makes a big difference. Now, the flip side of that is the origin of brands from a country also have a huge impact. So the brands from particular country are looked at by customers in a certain way. Germany has brands being looked at by the customers from a very different way. The engineering prowess and the technology that they come up with. A lot of brands from America are very technology focused, which of course China is competing now. But take Vietnam, for example, and I'll give you a more straight example of the brands from the country. There are a lot of times there are inherent disadvantages for the brands coming from a country that is not seen to be an expert or in that country. I mean, banks, for example, in Vietnam, no matter how hard they try, if there's anything to do with the Vietnam name in their brand name, that would prove to be a disadvantage. And we keep telling this to them all the time to say, take BIDV, for example, the Bank of Investment, Industrial Bank of Vietnam. The minute you have Vietin Bank, it has a very different image connotations onto the person's mind rather than saying BIDV. Because BIDV does not necessarily bring in the Vietnamese connotations to you. I mean, take Techcom Bank, for example. It is a Vietnamese bank, one of the fastest growing banks in Vietnam, but because you don't see the word Vietnam there, you probably will be more receptive to them versus someone that has the word name Vietnam in it. Again, for the banking sector, but if there's something to do with tourism, it will have a completely different impact on you. So there are categories that behave differently depending on what the country's core skills are and how they translate onto the brands. And that goes whether you're going out or you're coming in. We will talk a little more about that later. So,
Okay,
moving
so
on.
I think I've been warned that we're stretching the time. So I think I want you to complete the presentation. So let's move on to your next part of your conversation, Samir. Please go ahead.
So brand affects a variety of stakeholders, and there are largely not just customers, and that's what the again understanding is the brands impact customers more than that. But if you see here, the customers are just sort of two boxes: the external audiences in terms of influencer, trade channels, a whole lot of different set of stakeholders that the brand influences, staff, financial audience, etc. And all these actually are evaluated when we're doing the valuation at a different level. There are direct and indirect benefits of brand being used effectively. So if you have customers, you have higher revenue and costs, lower costs. If your brand is strong, if you have suppliers, they actually give you a cost advantage when you go and procure things from them. It's easier for you to recruit people when you're a stronger brand. So brands have a lot of direct and indirect benefits, and those should be kept in mind. It's not just helps you sell, but there are a lot of other areas. Better understand the value of the customer segments, you can do that. So valuation is a tool, and we always say that it can be used for a variety of things. I've touched upon some of them earlier. You should be able to link it to strategic marketing initiatives and ROI. Help yourself understand, again, in a very competitive context, how the strengths and weaknesses of the brand, etc., are following. And you can do a lot more. It is a very, very important marketing tool. In fact, the values that we publish are now certified by MASP, Marketing Accountability Standards Board, as the true measure for marketing ROI. So it's not just something that we advocate. It's been validated externally by a global body as well. As intangible assets, when you're actually valuing, what are these and what is it? So you may come across some technical terms here, so just bear with me. There's something called useful economic life of an asset, and that basically says how long that asset is likely to last in a real world scenario. And then we'll start to look at that from UEL point of view. The longer the useful economic life of an asset, the higher the value it will have, or the more valuable it should be. So you have technology related intangibles, you have artistic intangibles, you have marketing intangibles, you have contract-based intangibles, customer-based intangibles. So again, there's no one type that's there. There are lots of different types of them. Marketing related intangibles is where the brand is and what we call the trademark. But I mean, take Starbucks, for example, their shop design, the way they brew coffee, and a whole lot of other things, even how they display, all those are intangibles. Useful economic life, this is more of a technical debate, but basically it more applies to patents and less to the trademarks. A lot of companies have patents, and there's always been a debate that patents are more useful than the trademarks, and we always rather vehemently disagree with that, and I'll tell you in a moment why. So the useful economic life is low for some types of intangible assets, customer lists, marketing materials, advertising. They're more to the left-hand side. And as you go towards trademarks and URLs and musical work, etc., they're more on the higher side. The useful economic. So basically what the useful economic life for the patents is, the patents are protected for 20 years, and that's the useful economic life. After 20 years, so anyone can come and actually, you lose your patent. So someone can come and copy your products effectively, unless there are other things in it. And that's where the brand sort of kicks in to say, look, this is a brand that people would prefer. But if someone comes and improves on your invention, let's say in year 2 or year 3, the useful economic life is even shorter. It's just gone in thin air because someone has come and improved upon that. And that improvement is now more popular than what you had created. So the useful economic life of software and databases and patents is always a question mark. Trademarks, on the other side, have indefinite useful life, infinite useful life, because the brand is not going to die in 2 or 3 or 5 years. And that's why when we are actually putting a value to the brand, our calculation factor in the value calculation till perpetuity. So there are ways to do that. So that's where trademarks have high useful economic life, and that's why brand is more important. A lot of companies are very patent focused, but guess what? A patent always needs a brand. A brand does not require a patent. So if you have a lot of patents that you're focusing on, go back to your management and tell them, link those patents to a brand, because the brand is what's going to outlast and outsurvive those patents any given morning. What are we valuing? And again, when we value, so let's say the enterprise value of the business is 199 or 200 million, out of which your tangible assets, which are actually the tangible assets on the balance sheet, your plant and machinery, a lot of other things that you may have, your stocks, etc., are only worth 53 million. So where is that other 88, sorry, that's 133. Where is that other 80 million coming from, which are the intangible assets? When I go later to the GIFT study, you'll see a global average for tangible to intangible is almost half of all companies' value globally is in the intangible. And that's a very large number for people to miss out or not know how it functions or what makes it work or what is the contribution of that 50%, where is it coming from? And not knowing that also means that your management and your company and your CEO is only focusing on half the business, not something they're paid to do. You're supposed to focus on the full business. So in that 80 million, it could be different things that actually have a different level of contribution. So marketing intangible, customer intangible, contracts, technology, goodwill. This is just an illustration, so don't worry about the numbers. But it could be contributed by different things. And I'll show you now a real example of that just in a moment. So this is a business value breakdown of Apple. As of October 2016. I've used an older number. So enterprise value is 441 million. The intangible value is 366, and the tangible assets only 76 million. It's a highly brand-driven business because look at the intangible value, look at the proportion of it, and that's why the brand is absolutely everything to the management, to the people of the organization, and everything. Now, within that, the disclosed intangibles are only 8 billion, and the undisclosed are a very large number because you don't know. Yes, there are intangibles, you don't know what they're made up of. And that's where one of the earlier surveys was talking about was there needs to be higher level of transparency of what those intangibles are so that market is better informed and people can make better investment decisions into those companies, for example. Now, we have broken it down using our methods, etc. is all right. So out of the total intangible of 366 billion, 37 is goodwill, there's contracts, there's customers, there's technology, and that's marketing intangible. In those marketing intangibles of 110 million, 107 is the brand. So you can see how you need to slice and dice A. B also, it puts some context and perspective of when we're talking about the brand, what really are we talking about? We're talking about the marketing intangibles. There are other types of intangibles through customer intangibles, technology intangibles. Technology intangibles, these could all be patents, for example, right? So, and then what is left at the end of the day is what we call goodwill. And that's what, historically, all this would have been called goodwill. So there are different ways of valuing, and now we're just going to get into how are these things valued very quickly. Now, if you look at this, these are the, you may have come across Interbrand's published brand values as well. There are largely 4 entities that publish the values nowadays. It's Interbrand, it's Brand Finance, it's Forbes magazine has also started printing the rankings and the value of the brands, and there is Millward Brown through the Brand Z study. I'll just touch upon each one of them. Now, Brand Finance would value the brand value to enterprise value is 29% in January 2015, and in October 2015 is 30. Interbrand is valued at 30%. Then in 2016, 1 year later, we have valued it at 146 billion, and it's still 29% of the enterprise value. Interbrand valuation has increased the brand value to 36% of the enterprise value. Now, Brand Z, on the other hand, over these 2 cycles, are 43 and 64% of the value is of the brand. Now, that's not really something that's palatable or digestible, considering I've just shared all this with you to say, where are all the intangibles coming from? So the brand cannot be as high as perhaps Interbrand has shown or Millward Brown Brand Z has shown. Now, why are there all these differences when you start to look at some of these different rankings? Is very simple. Everyone is following a different methodology, and that nicely brings us to what are the methods and what's a good method and what is the most appropriate method to value the brands. I'm going to probably come back to this, but this is just to illustrate the multiple steps that are followed by different people. By Brand Finance follows multiple steps, Interbrand follows, and Brand Z follows. Just from a context setting point of view, don't worry about reading any of this. look at how thin the brand Z analysis is, and there are very few components. So that would mean there are more black boxes within the methodology. Interbrand is slightly better. I'm not saying this more because we are brand finance. This is something that we would say in front of anyone historically. Now, the only thing that I want you to take note is here, this is, we are using the royalty relief method, they're using the earnings split method, and Millward Brown is also using the earnings split method. And that's why the methodologies also vary, and that's why some of the components that are factored in also vary. And I'll just come to the different methods in a moment. IP ecosystem, what is it? Clearly, there's a lot of focus on the creation, and there's a lot of focus on protection and enforcement, which is really the legal domain. But after that, actually the marketing people do have to step in and start to nurture and take care of the IP in terms of the maintenance, in terms of governance, rejuvenation, and IP enhancement. And there is very little that's done on the bottom part, which is the enhancement of the value or the commercialization or the exploitation of the value. And typically a lot of internal focus from the organization, from the management, from the board is always about protection and enforcement, but that's not where you stop, because that's only protecting it. It's not necessarily creating or generating value or taking it to a different level. That comes from the value enhancement strategies, that comes from commercialization strategies and exploitation strategies. So, for example, I mean, Apple has a bank now, right? They were using the digital license from banking license from a third party, and they launched the Apple credit card. And that's really about exploiting the IP to another area where they think they're going to be very successful because of the customer universe that they have, and there's a natural fit there. Who knows? They've been sort of rumored videos about Apple car coming to the market, and then will that give a run to Tesla for their money? So it's how much extendable your brand is. I've talked about this already, the tangible to intangible value. 48 to 52% of all companies' values in the intangible. Not knowing about them or letting them be managed somehow by themselves is not a good idea, because that's where the value generation is significantly more than on the tangible side. In fact, tangible assets are always depreciating assets. When you have a plant and machinery on the books, when you have a land on the book, when you have any tangible asset on the book, it actually depreciates year after year. Brand is one of the very few assets that actually appreciates year after year. That's the appreciating asset. The tangible assets are depreciating assets. So always keep that in mind. So the focus should not be on the tangible side, should always be on the intangible side. These are just different world's most intangible sectors. If you look at aerospace and defense and personal care, internet, software, healthcare. So the blue part is the tangible assets, and the rest is all intangible. They have a lot of intangibles there. We look at the top 10 most intangible countries. So you have United States. The reason I'm showing this to you is not so much for you to say which is the country, but look at the graphs here. So that's starting at 2019, and that's on January of 2019, and then we move on to 2020. So this is just at the back of when the pandemic was breaking in, and just to show you the intangible countries, how they've sort of grown. So what really usually takes a hit in a crisis is the tangible value, not so much the intangible value, and that remains either protected or remains high. Now, if you look at this in the middle of the pandemic, there's just a tiny dip, but overall, the last purple bar is the intangible value at the back of 2020, towards September 2020. And look at the increase there is. So always keep in mind during the times of crisis, and people say, don't waste a crisis. We always say you must continue to build your brand in a crisis, because it's more important than ever. That's the bottom 10 least intangible countries. You'll see Luxembourg is there. You see a lot of African countries there as well, some European countries. Strangely or sadly, you'll see that Singapore is here. overall in the bottom intangible, because again, when you look at the Singapore companies and Singapore brands, they're very intangible driven. They're very tangible driven. They're very balance sheet driven. We've seen very little focus on the intangible other than the top 10, 15 brands in Singapore, and we'll come to that later. What are the key contributing factors? Just because your brand value is decreasing does not mean that it is because of the brand. So I just want to touch upon that, and I've used 3 examples there. This is DBS's value over the years. 2.8 billion rose all the way to 9 billion, then 8.4 billion, and now 7.3 billion. Basically, that means is if I want to buy the name DBS tomorrow morning, nothing else, no assets, no office, no materials, no nothing, just the DBS name, I have to pay them $7.8 billion, if not more. So that's the value of the brand. The brand strength is AAA. It's a very, very strong brand. It's a score we get out of 100. When I take you through the steps of valuation, you'll see that this is very important. The brand value to market cap or the brand value to business value, as you saw in case of Apple, we were saying is 29%. Interbrand was saying is 36%, and Millward Brown was putting it as 46%. What that basically means is that 16.7% means the higher the percentage means the brand is driving the business success. The lower the percentage means the brand is doing very little or nothing to your business success, and the business is driving the brand. So when any of you who are looking at these numbers in the future, do keep that in mind. The percentage for commodity brands is going to be really, really low. The percentage for branded organization or heavily branded businesses is going to be reasonably high. But having said that, there are 3 contributors: the brand, the business, and external factors. Now, external factors you have no control over. The business performance is also driven by, you have some control. You may not have some areas that you control because there are a lot of competitors, regulations, market conditions, etc., that may be influencing the growth or lack of growth.
Okay, excuse me, I just want to interrupt. So that Hewling has given me a 10-minute warning sign. So I don't know how you're situated with the conclusion of your presentation here. So just keep that in mind. And then we have a bunch of questions that I think are coming through that you might have time to.
So basically, we're looking at, is the brand contributing or not contributing? So always keep in mind that it's not always your business or external factors. The brand contribution should always be there. So in this case, while there's a big decline in value from 8.4 to 7.8, is the brand that's still contributing $236 million. And that's the ROI for the marketing folks is, look, I have contributed whatever marketing investment budgets were given to me. I have contributed $236 million in a year, whereas the businesses and the external factors have actually taken away a very large part, almost $800, $900 million, and that's why the brand value is reduced. So it's a good way to showcase your ROI or your KPI as the brand value increase or decrease, purely attributed to the brand. I'm going to skip some of this. There's just Techcombank, everyone's contributed. Here the CIMB brand has not contributed. The value has got some contribution from external factors. So again, there's no right or wrong. There's no one side. It all depends where you are, what you're doing, and how you're going about it. And like I said, the brand is, you have full control over. Business performance, you have partial controls over. External factors, you have no control over. So the brand should always be contributing. These are just some of the percentage, the brand value to enterprise value. You'll see watches, for example, luxury segment will always have very high BV to EV percentages. And as you go down more towards the commodity side, they will keep reducing. It's also a good benchmark for the brands to have, to say, how much do you have as BV to EV? Just about banking, you should be at least 22%. If DBS is 16.5, they should be looking at how can I move up to a 22, 23, 25% BV to EV ratio. And that means how do I increase the brand value going forward? Okay, so we have the methodologies. Basically, there are 2 parts to the calculation. There's a valuation, there's an evaluation, and both have come under the ISO purview now. That ISO 10668 is the valuation, and 2067 was the evaluation part. I'm not going to get into the details of this. But basically, there are 3 fundamental ways to value anything. There's a cost approach, there's a market approach, and there's an income approach. Now, take, for example, if you were to buy the building that SMU is in, and you were to apply the cost approach, how will value is using what is the cost to recreate. So the cost approach always looks at cost to recreate. Land, material, period over time, etc. We'll add everything and they'll give us a cost approach. And that's how you value. The market approach will look at what is the going price for the nearby building, and I'll use that as a benchmark to buy the SMU building, and that's the market approach. The income approach looks at it very differently. How much money can I earn from that SMU building in the future if I were to buy it? And so basically the income generating ability. The brands are valued using income approach. There are direct methods, there are indirect methods. Under direct methods, there is a royalty relief method, which is the most popular method for valuing brand, not because that's the one we use or that's the one we specialize in. We specialize across all these methods: cost, market, income, and direct, indirect. But that's the method that's most recommended by IVSC, which is the International Valuation Standards Council. That's the method that's acceptable to the tax authorities. That's the method that's acceptable to the court should there be a dispute for the brand. It is also applicable to, it's also acceptable to auditors. So it's not something that is a preference from our side, but that's the industry's most recognized method to value the brands. So if anyone else is valuing your brand using any other method, then just do question to say why. Having said that, when we look at the brand contribution, the one I showed you earlier, of with or without the brand, that's where we would bring in other methods. So a lot of times we can use blended methods in terms of volume premium, price premium, and then go back to the royalty relief and say, all right, how do I calculate the value? But royalty relief is the way to value the brands. What does it fundamentally mean is if you did not own the brand and you had to pay someone else to use it, how much would you have paid? And because you own it, you're given a relief from the royalties. So that's where the royalties come in. And the royalties are not something that you pluck from thin air. You actually have to look at the royalty databases, or you have to have a very strong rationale of why you're charging a 1% and not 0.5%, or why you're charging a 5%, not a 3%. So the royalty relief basically looks at what is the royalties that you're going. The ISO requirements for valuation, again, I'm just going to point out a few things here which are very, very critical. Is the purpose of valuation. Very, very important. A valuation is done for a very specific purpose, and it cannot be used for a different purpose other than what's been done for. So for example, if I'm doing a valuation for listing, you cannot use it for delisting. If I'm doing a valuation for transfer pricing, you cannot use it for listing. If I'm doing a valuation for impairment testing, you can't use it for transfer pricing. So there are a lot of technical reasons for the valuation to be done, and it cannot be used one for the other. The other two important points is the date of valuation and the value date. So I may be valuing a brand today, but I may be valuing it as of 31st of March 2021. So it doesn't matter when it is valued, it's a point in time cutoff, and that the date of valuation is what the valuation date for the brand is, not when it is actually being performed. It could be 2 years ago that I'm valuing it as of 2 years ago. So just keep some of those things in mind, and these are all some of the ISO requirements. There are 4 steps. So we first look at how strong or weak the brand is in the royalty relief method. Then we see a strong brand will attract higher royalty, a weak brand will attract lower royalty. So take McDonald's, for example. If you were to license the McDonald's name, you'll have to pay higher royalties to them. If you were to get a Mossberger franchise, you'll have to pay lower. So stronger brand, higher royalty, weaker brand, lower royalty. We apply those royalties to the future earnings or the forecast of the business and the company. And then there are some discounting processes that are factored in, and then you get to the value of the brand, which is calculated for perpetuity. These are just the ISO factors that actually apply to it. And very quickly, and I'm just going to run you through the top 100 brands, and then we'll be stopping for quick Q&As. So these are top 100 from the top 500 global brands and the top 10 most valuable. Interestingly, you'll see 2 things. One is all of them are technology brands except for ICBC. So there's only one bank, rest are all technology brands. Like I said, 10 years ago, this used to be the G's and Coca-Colas of the world, but not anymore. And a lot of the banks were there. So that's all gone. 263 billion is the value of the Apple's brand name. Amazon closely behind them. This is so there are 2 parts to it. being the most valuable doesn't necessarily mean you're strongest or vice versa. You may be the strongest brand. So one would think, so what about the Cokes and the Pepsis and the Ferraris of the world? Well, they are very strong brands. They're not as valuable because they don't generate as much money as some of the tech brands do today, but they're extremely strong brands as well. So Ferrari comes number 2. WeChat actually is number 1. So here you see, so you should have a KPI for the brand strength as well as the brand value. Don't have one or the other, because the two are both an integral part. In fact, if you have to have one or the other, have a KPI for brand strength, because the stronger the brand, the better everything else will be in the future. Our brand strength, when you see a AA, AAA, it basically goes in the order AAA plus, AAA, AAA minus, AA plus, AA, AA minus. There's not the credit rating, is the brand strength rating that's derived from a score from 0 to 100. We do extensive research across 29 countries, more than 50,000 participants. So all that goes into the brand strength calculation. The total brand value of top 100 Asian brands, now I'm just talking about the Asian brand, is $2 trillion, and enterprise value is about $12 trillion. So you can just see what is the percentage of brand value to enterprise value is more than roughly about 25 to 28%. And that's a very, very large number. Here is the big problem. Now look at this circle. Look at this half. Top 20 brands are accounting for more than 50% of the value. And top 50 brands are accounting for almost 78.2% of the value. So it's really about who's at the top. And that's where we've always seen a split or the fragmented strategies. And not to say that the brands at the bottom are not making enough effort, but it's just that they're not always focused on the brand. They're more focused on business, and the companies at the top are equally focused on the brand. I would not say they're not focused on the business. They're equally focused on the brand. They put efforts and energies and money to build the brand, and that's why they are where they are. These are the top 100 most valuable Asian brands. Samsung is number 1, then ICBC. So again, ICBC is the only bank there, and then you see again majority of them are tech players. This is the one that I want to bring everyone's attention to. And the question earlier about the country is, look at the circle for China. Majority of these brands are Chinese brands. 8 out of the top 10 are Chinese brands. Why is that happening? It's not happening by accident. It's by design. A few years ago, in fact, I will use Samsung as an example first. The Samsung chairman 10 years ago said, I want to be the #1 brand in the world in X amount of time, and let's just work towards that. So it was a strategic agenda for the entire organization. The same thing has been done in China. The Chinese premier has said, I want at least, majority of the top 100 global brands to be the Chinese brands. So it's being done with a concise strategy. It's done with in a very coordinated design manner. These things are not happening by accident, and that's why you see Chinese brands everywhere, because they're actually building the brands in a more coordinated manner. Top 10 strongest brands, again, you'll see majority of them are from China. In fact, the top 5, there is DBS and Petronas. So 2 brands from ASEAN countries, but majority of them are again from China. Brand value by country, no surprises here. Japan follows China after that. That's India, that's Singapore is here, again only 1 brand. So this is again proportionate to the number of brands from the country which are actually in the top 100. So clearly China takes the bigger pie of that. Sectors, which are the big sectors? Banking, tech are the 2 large sectors, then you have telecom and oil and gas, etc. So these are big sectors. But having said that, don't just necessarily get influenced by the size of this pie, because it is again how many brands are there. So don't think, oh, if I'm not in telecom or banking or tech, if I'm spirits, then I'm not likely to grow as quickly or as much. Because if you look at the table on the right hand side, which is where we mentioned the number of brands, then the banking is 14 and the tech is 12. So the proportionate size is roughly the same in terms of the overall value of the brands. Pandemic impact, I think very, very important. Which categories got more negatively impacted with the pandemic in terms of the brand value? You can see here leisure and tourism, huge hit, airlines, hotels, beers. Interestingly, beer got more hit than the spirits. Spirits is actually in the positive growth category, because beer is more probably drinking out, going out of home drinking linked, whereas spirits maybe had at home also. The spirits have gone through a different kind of boom, and beers has gone through a different kind of bust during the pandemic because of the lockdowns. So again, different categories have behaved differently during the lockdown. Oil and gas, again, lockdowns, less consumption, big impact on the future growth, etc. So all those things, cosmetic and personal care, taken a big hit. Here the sectors have actually grown very well, even during the pandemic. Technology, retail, spirits, like I said earlier, tobacco, I guess people are just more stressed, so they're smoking more. Real estate, massive liquidity in the market. So real estate is going through a very different level of boom. And in case of China and Evergrande, probably a bust also, but very different level of boom. Household products. So again, the liquidity is also driving a lot of segments because that money is not being spent on tourism and other things. These are the top 100 Asian brands. I think when the deck is circulated, you will have that. So I'm not going to really go through these. Case studies, I think during the questions, I'll try to answer that, or if we have time at the end, we'll come back to that. But that's really my last slide. Over to Prof. Srini for the questions.
Very good. Yeah. So a bunch of questions, Samir. I'll try and organize them a little bit, but here is one which essentially, I think it deals with question on Singapore as well. The questioner asks, based on what you have said, the top brands in Asia, do you think China, Korea, and Japan are on the top because the government help and support? So should Singapore also support and help the local brands?
So Singapore does support and help the local brands, and they support and help in a much bigger way than probably China and Japan or other countries do, because there's massive amount of budgets and fundings available. The big question is, what is that support being used for? Is the support being used for just some cosmetic changes, or is that support being used for effective ways of managing or growing the brand? And we've also sort of had this question, or this debate has been going around within the government also, is when you fund something, how do you evaluate the benefit of that funding? Is that benefit of the funding being measured in terms of the value the business has grown, or it's all right, as an owner of the brand or the business, I don't like the logo, I think I'm bored with it, call someone who will just do some research and then do some creative adjustments, and then that's about it. Costs a lot of money. Does it really benefit the brand? May or may not be. It all depends how, and so you must do the analysis from a value increase point of view. And I think that's where the companies need to take the initiative more than the government, because the government is already doing a lot.
The next question is again dealing with some of the big brands in Asia. The questioner says, is WeChat and Geo with higher rankings because of being based in very populated countries like China and India, as these brands are not very popular elsewhere? So the impact of just being in a large country, does it actually have a huge impact on the rankings?
It has an impact only to the extent that what is your future growth likely to be, or how competitive you are even within that country. Don't forget that just because these are big countries doesn't mean that you will be automatically successful, because there are many other competing brands in the big countries. There are 10 times more brands in those big countries than probably in the smaller countries, because the size of the market is much larger. But having said that, the addressable segment again hugely varies within these big countries, and certain brands can only attract the top 1% of segment, certain brands can only attract the bottom 3% of the segment. So there's no real advantage coming from the big countries per se. It is all dependent on if there are countries that are well protected, they don't allow any foreign competitors, that's a different scenario. Don't think that applies to either India or China. China probably has some protection for foreign countries, foreign entities to come in. India is a very open business democracy based country where foreign competition is there in a lot of local competitors as well. So yes, it helps because you have those many volume of customers to tap into, but not necessarily the case.
Very good. So I'm combining two questions which are related to it. I don't know how far you can go into this in this small amount of time that we have, the little amount of time that you have. The question is, can you elaborate on the methodology that you use in brand finance in detail, in greater detail is the question. And the other is, the person claims, for beginners, what are some of the metrics that you would recommend to measure and track a company's brand value? So you can address it in different ways. You can refer to the first questioner, places where they can get more details on what methodology that you use without giving away the proprietary sort of details. So try to see if you can address that question. And also the other one is much more generic. It says, what would you recommend to measure and track a brand's value for a company?
All right. So I'm going to bring you back to this screen where the methodologies are. I think that's the easiest way to very quickly explain it to them. So again, the proprietariness of the method comes in certain parts of the process, and we don't have any proprietary element to the entire process. These are established accounting practices. So a royalty relief basically starts with how strong or weak the brand is, and that's really the first step. Of course, we start to analyze the revenue forecast and historical performance of the organization, etc. But like I said earlier, a strong brand can have higher royalty application, a weak brand will have lower royalty application. So we first look at the brand strength. The brand strength is a more holistic method of assessing the brand rather than looking at the brand equity by itself. And that also has been under the ISO purview now. In fact, they've adopted the methodology that we had created 25 years ago, and that's been now put under ISO 20671. That looks at three areas. It looks at the inputs for the brand, it looks at the equity for the brand, it looks at the output for the brand. And all three are combined under one single framework to see what is the input, how does the input impact the brand equity, and how does the brand equity then impact the performance of the business. Inputs are all your things that your products, your promotion, your place, everything that you control 100% are your inputs. Those inputs generate the equity for the brand, and that brand equity then drives the business for the success in terms of sales volume, in terms of profitability, in terms of market share, and a lot of things. So all those come under a single framework, and that's what gives you the score out of 100. So that's the proprietary part of it, is the brand strength index that we have. That brand strength index, then based on the score, if you have a score of 50 and let's say the royalty range is 0 to 100, you will get an application royalty somewhere in the middle because your brand is halfway there in terms of brand strength. As the brand strength keeps on increasing, the royalty application keeps on improving just the same. Once we look at that royalty calculation, then we apply that to future earnings. So we look at the next 5 years forecast and we say, all right, what is the royalty that we should apply? And based on our calculation, we say 3% of this future revenue is dependent on the brand. So we take away the 3% revenue, then that 3% revenue will also have tax component in it, will also have other components in it. So we take the tax out of that 3% and we then discount it to net present value. Because this is a future earning, $100 5 years from now will be worth a lot less, or $100 today will be worth a lot less in 5 years' time. So we discount it to net present value. So that's really the broad steps of it. When we calculate the value, it's in two parts. One is the 5 year, what we call the explicit period, and the other is the perpetuity value, which is 5 years till perpetuity. And then the two numbers come together to give us the value of the brand. In the end, if we have a few minutes, I'll probably just quickly open a slide and show you a calculation in a chart. But broadly, those are the steps. The proprietary part is really the brand strength analysis that we do, and also the discount rate, etc. Those are all calculated differently by different people, different organizations. They may have different views on it, so those might be slightly different from each other. So I hope that answers the calculation part. Was there a second question there? Sorry.
The question I think was, he said, as a beginner, I'd like to know how to track brand value. what are the key measurements that one could use to?
Okay, so the measurements that you should use internally is really three things. So first of all, go back to the basics. How is the brand managed internally? So brand governance is the most important measure, as you said, because if you're not measuring or managing that, then the brand is not going to have a positive impact through the line. Second most important KPI measure should be the brand strength index that you should be measuring, because that is directly related to how the value will increase or decrease in the long run. The third KPI for the management should be the brand value itself. So if you ask me what are the three most important KPIs that the management or the brand custodian should have, it should be the GSI, which is the governance strength index, it should be the BSI, which is the brand strength index, and it should be the brand value. And I think if you're on top of those three, you will have a very successful, very valuable brand in the long run.
Okay. The next two questions, and I think these will be the last two that I think that you can entertain, Samir, as we're running out of time. What is, in your view, the purpose and the utility of EDB, Singapore, brand building activities? Okay, that's one. And there's actually a fairly interesting question, which actually suggests that the government probably can do more targeted approach for selected or highlighted possible high growth brands, and not just a broad approach. I mean, so these are the two questions. I don't know if EDB fits into this or not, but the first question was specifically about EDB and the utility of it for helping Singapore brands. And the second one is a little bit more pointed in terms of saying, is the government doing the right thing rather than provide broad support? Should they be not focusing on specific aspects of maybe specific brands, high growth brands that they choose?
So I'll answer the second one first, and that'll lead into the first one automatically, hopefully. So the government is not just focusing on big brands. It may seem like that, but because we work very closely with the government focus is as much on SMEs. And historically, there were two entities. Now they merged into one. It's called Enterprise Singapore. They used to be Spring and IE historically. The focus of Spring used to be to focus on all the brands which are less than $100 million and grow them, nurture them to be big enough to get them kicked out of the SME category. So the government agenda was very simple. How can we make the SMEs become non-SMEs and let them grow towards a high order? Make them, the IE's job was slightly different. Once the SME brands are local brands were focused on by Spring, and the IE was focusing on the internationalization of the brands. So any brand that was present or had the ambition or had the potential to grow outside of Singapore was being managed by IE. Now both have been combined and are looked out after by Enterprise Singapore under one umbrella, which probably is more for synergies, and also they have an end-to-end view of everything, which is a great thing. But that is their agenda. So it's not that they necessarily focus on the big brands. I think the government is focusing through the line. At the end of the day, it's the intent of the brand or intent of the brand owner that really makes a difference to say how far you want to take your brand, or how much do you want to take advantage or benefit from all these different schemes and offers. And a bit sad, as we've seen, that unless the government is willing to fund something, the companies do not want to do. So for example, if we go to the company for a particular project, or they buy into it and say, yes, we want to do it. If there's no government funding, we don't want to do it. Hold on, it is your brand. Are you saying that if the government is not funding it, you don't care about your brand? And that's really the problem. The government should not be spoon feeding the companies. The companies should be identifying their own need, their own potential, and then saying, all right, now let's see where the government can help us. The government is extremely, extremely helpful. They have all the right processes, all the right tools, but at the same time, the companies must focus on their brand as the focus agenda themselves. Move over to EDB. The EDB's role is two levels. One is bringing in companies that then can support the SMEs, bring in the expertise that can help these SMEs sort of get plugged into the bigger companies and grow quicker and faster. That's one. Second is to also build the nation brand as Singapore as a country brand, so that the brands from Singapore are those many times more receptive, more competitive, more profitable as you go outside, because the brand Singapore again carries a certain amount of weightage. There is a reason why Singapore Airlines commands a very high price premium versus some of the other airlines in the region. So EDB's role is to grow the company, to grow the economy as a whole, and bring in companies, bring in talent, bring in infrastructure, bring in focus strategy, so that all these companies across different levels, big or small, can sort of plug into some of those and benefit from it and learn from it and then grow their footprint. The IE's role is really to focus on individual companies, individual entities, and they're not biased in any ways. And we've been working with them for 10 years, so I can say that with a great deal of surety, they're not biased in any ways. They treat $10 million company or a $1 million company with as much care and attention as they would treat a $100 million company. Their purpose is grow them beyond SME sector, let them go to international levels. But that, at the end of the day, it's the management's intent that we've seen as a barrier, nothing else really.
Fantastic. Samir, thank you very much. And thank you for all the participants to have so enthusiastically asked the questions. So my apologies in case I missed anything, but we're really running out of time. So I just want to leave a few minutes for you to sort of finish a questionnaire that Huling has provided you. But also personally want to thank Samir for a wonderful presentation. And obviously the brands are still alive and kicking and incredibly resilient despite the pandemic which has hit us during the last year and a half. So thank you for sharing what brand finance does and then how brands are such an integral part of our economy, whether it's in Singapore or in Asia. And I think thank you for sharing all of that, Samir.
Thanks everyone for attending, and thanks Prof. Srini and Huling for arranging this session. I think hopefully everyone is a little more informed and educated about it. I just want to leave with two thoughts, everyone. One is on the slide there. If you want your brand to be an asset, start treating it like an asset, because if you're not treating it like an asset, it'll never be one. Second is the brand is the only thing that survives even if your company is dead and gone. There are brands, if you want to buy a Lehman Brothers name, for example, if you want to buy a Enron, all the companies that have been historically dead and gone, you would still have to pay a price for them. So the brand is the only asset that will outlive everything within the company, within the business, is the brand. So, and it's an extremely valuable asset. You can sell it even after your business is closed down. So just take good care of it.
Fantastic, yeah. Thank you. On that note, let's give a round of applause. Yeah, so thank you so much, Samir. Until we meet again.
Have a good day, everyone, and stay safe.